Hi, Tony Selzer here. Welcome to Galvanize. We've got Don Aquilano. We've got Dustin here, really talking on our second series about Indiana as a market, growth, raising money. This is a big issue for. I jokingly said that for the last 20 years I've been begging for money, right? Mm-hmm. And I mean we've been a part. I've been a part personally of I think it's now 9 raises, and it is one of the hardest things to do, right? And I constantly go back and forth. I know you're in that mode. It's like you have a cash hungry business. We're doing a .com. It's always this game of, do we go sell or do we go raise? And knowing getting to corner you now as the VC, right? How did you deal with the psychology of doing that? Because you did it before. Right. You actually did it.
Right.
And as a fund, you're actually out there raising too, right?
Right.
And so it kind of, you're on both ends, right? So talk to me a little bit about the psychology of raising money, and then talk about, give us some color about what you guys look for, right, what makes sense, and when it doesn't make sense.
Right. So that's actually a very good question. So the from a psychology perspective, from an entrepreneur raising money, you almost have to put yourself in like a salesman mode, right? Mm-hmm. You're going to hear a lot of no's.
It's a numbers game.
You're going to hear an awful lot of no's. Mm-hmm. And the reason is you've got to have a complete alignment of the stars for you to get that capital. You've got to be a great fit. You've got to have the good people, the right market, the right differentiation, hopefully IP, and so on. You've got to align all these. And then you have to be better than the other deals that VC is looking at. Right? The opportunity cost. Right? Because now flipping to our side, we have only so many slots from which we can invest. Mm-hmm. So we've got about 20 portfolio companies right now, about half are in Indiana, mm-hmm, right? But we have looked at 1,000 or more to get to those, mm-hmm, right? Mm-hmm. And so the dirty secret about venture capital is we say no to almost every opportunity we look at, mm-hmm, because we can only do so many, right? And it's very hard, and we're not always right. We have to pick the best of the 10 or so that are a great strategic fit for us at any one time. Mm-hmm. So the psychology, you almost have to put yourself in the mindset of a salesperson, which is, I'm going to hear a lot of no's. And it's not all about...
more than you're going to win.
Absolutely.
Yeah.
Mm-hmm. Absolutely.
So Dustin, on your end, how have you figured out how to raise money for the real estate stuff that you're doing? When does it make sense for them and you?
Well, we talked a little bit about this in prior episodes. Real estate's a little different because... you can always go the hard money route, mm-hmm, and hard money lenders are just out there begging, waiting for.
Can't wait to give it to you.
Can't wait, because especially if you're a newbie. Yeah. Because they're going to charge you 15 and 5. Yeah. And so that's. Uh-huh. But so when you start out, you just got to take your licks. Uh-huh. It's part of your learning curve, school of hard knocks. Uh-huh. But once you get through and start doing more transactions, you start proving your business model, mm-hmm, you start proving that you're an educated investor and you actually got a business, then that money will start coming down. Mm-hmm. And then, again, it always goes back to, you can always borrow money on a real estate asset. Mm-hmm. Now, the next level is, okay, how do you go raise private money where it's more unsecured? Right. And you're paying a monthly annual dividend to that investor because you're talking to investors that have money sitting on the sidelines, have cash sitting in a savings account. So that's kind of the next level as an investor, going out there and doing that.
There was something Don said that I really wanted you both to expound on, and I just think this is one of the most important things, and you mentioned it with being, putting your hat in a sales role. This word is fit. There's such a big, important difference between smart money and dumb money, and I don't think people really understand that. I think that there is, if a fund is got a bio background, they're going to look for more bio businesses. If they've got a software background, they're going to look for people in your business. If someone does multifamily and they're in the quads to 12s, they stay in the game. They stay in their role. Why do they do that? Why is fit so important, guys?
Well, it's from an investor standpoint, it's what you know. Yeah. When you start getting into that, and then if you try to go to the private equity side, mm-hmm, they may have a PPM that keeps them only in that. Mm-hmm. In that business, mm-hmm, and as much as they want to go into the single family 1 to 4 unit residential side, their PPM won't
So
let
their
them.
governance won't even allow.
Right.
Yeah.
So then, like, if we want to get into that, then it costs a lot of money to go raise, to get the papers put together to do that. So, that's a big reason why too, that people stay in their lanes on that side,
Yeah, and from our perspective, we stick to our knitting. We stick to what we know. We stick to what's worked in the past. And part of our investment criteria is, can we add value to that portfolio company, right? Is there a fit with our experience, our know-how, and their needs? Because that enhances the odds of success. So that's important to us.
Well, and I think a lot of people don't understand when they're dealing with VC for the first time, when they get that rejection, they like my idea, they liked our concept, they like, but they reject the idea. When we're talking to somebody like you, Don, we're not talking to just you. You don't have full authority to do whatever you want with that money because you've got an end game that you're playing in that fund. And a lot of people don't understand what the end game is for the venture fund. Like you're only as good as your last fund, right? So if you are going to go get that next fund, the last one has to be performing well, right? And if you color down the lines too far and that fund's not doing what you said, it's really hard to go back to those same investors and ask for more money. Is that fair?
Yeah, absolutely. I mean, you mentioned the sort of the PPM. We have a PPM that says what we do and what we don't do. We don't do life sciences. We don't do B2C. We're not trying to figure out the next Snapchat, for example. If we came out and started investing in a whole bunch of B2Cs and then a restaurant and then a biotech company, we'd have an angry horde outside of our door, especially if we invested and lost money. That would be the last time we make an investment, to your point.
So talk to me about some of the, like, do either of you going after some of this family money, whereas the family has got large enough money that they're starting to use their own resources to manage that? Do either of you guys talk to those types of players?
Yeah, I mean, I got a lending partner that is family money, family office money, and it's fairly reasonable.
Okay.
And what's crazy is they reached out to me through LinkedIn.
Wow.
And so they were looking to get into Indianapolis, and you know how many LinkedIn messages you get from sales?
Wow.
A ton.
Right.
And I just so happened.
I know how many we said.
It goes both ways.
Yeah. And so I just so happened reach back out to this individual, and because I kind of researched it a little bit, because I always, when somebody wants to lend money, I always research them a little bit, and I saw they were in Louisville, and so I reached back out to them and found that they were a family office, and it's their own money they're lending, and the terms are more favorable, and they knew what they're doing, which is a big deal, and they, when you're in our world, closing quickly is the name of the game, and so that's one of the key factors when you ask about, okay, if you want to lend money, how quickly can I get it, and so. So we've started slow, but we've started to ramp up a little bit with them because they're trustworthy, and so far they've kept up to their word. So,
nice.
So I kind of fell into a family office that way.
How about you?
Yeah, I would say just in the Allos funds, we have well north of 100 million under management. More than half of it comes from high net worth individuals and family offices. And so these family offices that are more sophisticated, that are staffed to look at alternative investments, that they understand from an allocation perspective, 15 to 20% of that sort of asset group should be an alternative investment. So they intentionally look at opportunities like this.
Yeah.
Yep. So if you're out there and you're starting your own business, and that could be in real estate, that could be in tech, that could be B2B. I'm going to tell you right now, I'm ashamed. I have passed on 3 breweries over the last 10 years, and all of them are doing well. Right, and so it's one of those things you won't want to go back and kick yourself on. But as you're out there doing the race, how do you get your cards together? How do you get your everything that you need in order to be ready to pitch?
From my perspective, you need somebody who's experienced to give you some friendly fire, and I offer this to other. Companies where it's not a fit for us, I offer to help them with their pitch deck and make introductions. Part of the exercise we go through though is, do you really need venture capital? right? If you don't need it, you shouldn't take it, right? So understanding the business model, how do you want to grow? What are your aspirations, right? Because everything changes when you take sort of professional institutional money. The board, everything. And so, but we, you got to practice, and you need somebody who knows what that audience is looking for.
Yeah. I mean, from our small business, we've never gone after venture capital debt, so I can't really speak to that. But we go again more towards friends and family, people, kind of second tiered, people that have invested that refer out now, and a pitch deck is very important. Especially if we're talking to people that have experience investing, private money in real estate. So having a list of your last 20 deals. Showing that you have proper books, that you are tracking expenses and where everything's going. Because hey, if I'm going to put capital in your company, this isn't your money, like it's ours, and so let me make sure that you have the process and systems to get it back. So there's a lot of things that people that are asking me in our company to provide. And
with your business, they're investing a lot in the deal.
It's in the deal, and it's fairly easy to track because it's like, okay, put your money on this particular asset, so it's a little helpful.
With what you're doing, are you investing more in the team, the concept, everything together?
Yes.
Okay.
But it's all about people.
Okay.
So the team is at the top, the founding team. We say A's hire A's and B's hire C's. And so we spend all of our time looking for that A team. And yes, we want all the other things to be a fit and to be sort of compelling. But it's mostly about people.
So guys, there's one more thing that Greg had mentioned when he was watching the show that he wanted us to talk about. And I think it's a great point. When you look at what High Alpha is doing, right? I mean, that was the exact target team spinning off to create more teams. And, one of the VP of HR was actually reaching out to me just to talk because they were trying to find more talent outside the Salesforce exact target ecosystem, right? I mean, how much of a tendency does one generation tend to invest in the second generation? And is that a good thing? Is it a bad thing? At what point do we get into echo chambers?
So I would say, from my perspective, it is a great thing.
Okay.
There are very few companies that we're investing in now that don't have some exact target or primo DNA on the team.
Okay.
And if you just take a look at the folks who have done well from those success stories, they're doing one of two things. They're either like a High Alpha team, right? They're actually building new companies and investing in new companies. But also members of those teams are starting new companies that we're backing, right? So more so than most states I've seen, the success of Hoosiers, these guys give back. They give back by advice, coaching, capital investing, and sort of becoming entrepreneurs. Love it.
How about you, D? What do you see?
I think, my sister and my brother-in-law both work for Salesforce, and then originally Exact Target, and so they were part of that change, and they were part of the payouts and all the people leaving, and they still have some friends that went off and started new companies. Some have failed, but that's part of it, and they know some that have succeeded. And that it's amazing what the Salesforce, the acquisition of Exact Target has done for our economy. It's been crazy. And I got friends too that are out there that started as chiropractors, and then they sell that company and move on to another major business. And so it's not just in software and tech. It's just people moving on. The other, one business succeeded. They're like, okay, let's do something else that I'm truly passionate in, and they move into that, and it's just, you see that a lot. I mean, again, it goes with hand in hand with, age and what the economy's providing, and landlocked. There's room to grow, and so I see it being an extraordinary opportunities for all of us. So.
Well, I likened it to, there's two things there I think that come into factor. One is success leaves clues. Right, and so when you're able to model someone who's been successful, you're doing just that. You're modeling them. You're able to understand the behavior, understand the resources they need, understand the mindset that you've got to take. The other thing that's really important, you get to see that it's possible. right? And not when you sit next to somebody every day, they're a human being. They put their shoes on.
Mm-hmm.
They've got their faux pas, right? Like I can work at least that hard.
Yeah.
I'm at least that smart. I'm at least, why not me? And I think there's some of that mindset, some of that art of the possibility that happens from being directly rubbing elbow to elbow with some of these people and seeing them be that successful.
I mean, I was a banker for 12 years, and I worked with a lot of business owners. And you look at it, and they come in, and they're like, "Yeah, I own this XYZ company," and you're like, "You did that?"
Yeah.
And so it's like you're sitting there, and you're helping these guys and people that just took risks.
Yeah.
They aren't the smartest tools in the tool belt, and neither am I. But I'm like, it's all about risk and finding something you truly love, and then going and doing it.
Yeah.
And then fortunately, I was able to do that, and I left the banking world, and now I go see my old ex-bankers; they're still bankers.
Yeah.
So I mean, it's possible.
Yeah, the guts factor is
The guts
definitely
factor.
Yeah.